All right, everybody, welcome back to Market Talks with Dr. Stocks. This is Dr. Tom Carr, aka Dr. Stocks of drstocks.com, drstoxx.com, coming to you live from the live trading room where I hang out during the trading day with a really nice group of traders at all different levels. And if you want to join us and watch what I'm trading, get my entry price, stop price, target price, reasons for the trade, along with market commentary throughout the day and a live chart chat trader training session we do each afternoon, you can join us by clicking on the live trading room button right there and joining us in the Discord room. If you are looking for one of our award winning stock pick letters, you can go to subscribe. If you're looking for a trading system, click on manuals. And if you want to learn how to trade the way I do, click on webinars and you're good to go. All right. Before I get to some charts, I wanted to pull up a couple of charts if I can find my sheet here. Here we go. That came up on TradingView. So we're one day past the FOMC announcement, which happened yesterday. The market was a bit volatile on the initial announcement that the Fed was cutting 25 basis points. Not a whole lot of fireworks just yet. But then as people started reading through the commentary, the annotation of that, and seeing the dot plot, right, which is all the, what is it, 19 Fed votes and where they were at, not only with this December meeting, but future meetings in March, where they project they think they'll land, at the next January, March, April, et cetera, those meetings. And then you look at the scattering of those votes, how many basis points they think they need to cut or will vote on cutting versus where they were last meeting. And it had a shift. There was a shift toward a more hawkish stance. Fewer cuts, longer pauses, and fewer cuts overall in 25 and 26. And that sent some shockwaves through the market. Powell didn't alleviate things very much during the presser when he said basically that their focus was shifting away from a weak jobs market, which would be a concern for recession, and more back toward inflation because inflation has been a little bit sticky and they're a little worried about that. So that also sent some shockwaves through the market, and the market went down between 3 and 4% for the major indexes. But a lot of the big stocks, the big leading stocks, were down 6, 7, 8, 9, 10%. Some of the leveraged indexes, a couple of which we were in, went way down. So it was just one of those days. Everything kind of crashed at the same time. As background to that, we had the Congress working through this CR bill, this continuation bill that was trying to keep the Congress open. And it appeared more and more likely throughout the day that the bill was going to get squashed, which means that we're facing now, as of Friday, tomorrow, a potential government shutdown. Now, that shouldn't be too scary for the market because we've been through shutdowns before. In fact, back in 1990s, during the Clinton administration, the government shut down at least twice. I think it was 3 times. And we had a balanced budget during that, at least some of that. Balanced budget, roaring bull market, everything was going just fine. The government does just fine not working for a month or so, right? And in addition to that, the essential services, the entitlements and so on, those are all still fully funded. So that's, nobody's going to be in any major trouble if the government has to shut down for a month. And I think it forces the lawmakers to realize that we're living in a political environment right now that's very different than it was a few months ago. So all of that is to say, the market is having to price in a few things that it didn't see that it needed to price in just a couple of days ago. A more hawkish Fed, fewer rate cuts, not the easy, cheap money that we thought we were going to get into 2025, and potential government shutdown, and the uncertainty about what the new administration is going to do with respect to the economy. The economy is still looking really good, right? Still very, very good. We had GDP up higher than expected. We had jobless claims lower than expected. We had what was the other reading that came out? Well, manufacturing is just in the toilet, and it's been in the toilet for months, and I don't know what's going to help bring that back out again. But we did have a read on leading indicators. Leading indicators, which is it used to be really important. Now it's not that important, but for the first time in months, I think 8 or 9 months, it turned positive. So there's nothing wrong with the economy. The economy hasn't changed. Companies are still able to grow, and there's lots of demand. And in fact, with Europe falling, with China falling, I think America is just about the only game in town. So, and we've got a very pro business administration coming into power in about a month. So, all of that is good. I don't think that the big slide we saw yesterday and a lot of the leading stocks that just got whacked, don't think that's going to last much longer. So, um, all right. Now, here's another thing. So, this is a chart from TrendSpider, a service that I can recommend. I used to be a partner with them. I haven't done much with their charts lately, but if you buy my pullback webinar, you'll get a free month to TrendSpider, and the webinar shows you how to program in my bread and butter setup, the long and short version of the pullback. And it's a great service, very very good. Just has it has a little too many features for my taste. I like things a little simpler, but TrendSpider is a good follow on Twitter. They come out with some good information on the market overall every now and then. And this was posted just a little bit ago. So this is the S&P chart on the top, and down below you're going to see an indicator that tells you how many stocks in the S&P are trading under their 50 period moving average. I think I'm right in saying that. Pretty sure. Yeah. So how many stocks in the S&P 500 are trading under the 50 period moving average? And it's hard to see the numbers here, but it is above 50, more than half. It's right around 63%. 63% of all stocks in the S&P 500 are trading lower than the all-important 50 period moving average. 50 period moving average is roughly a quarter of trading. And so, stocks that are trading below their quarterly average, that's not a good place to be, right? That's a bearish place to be. When that number gets really high, we tend to see that coinciding with a bottom, at least a near term bottom in the market. If you go all the way back to May of 2023, which was pretty much the last vestiges of the 2022 bear market, kind of see that played out a little bit in May, and then we got a little bit more in September, October, as the last throes of that bear market were working themselves out. October was the major bottom. No more bear, perfectly new bull market. But you can see way back in May, we got that really, really high print. It was about 65%, I think, stocks underneath the 50 period moving average, coinciding with a bottom. We just got that same reading, just as high yesterday. Does that coincide with a bottom? Well, there's no guarantee that it does. It can go to 65%, it can go to 70%, it can go up to 100%. If we were in a major depression and the economy is falling apart, yeah, you're going to see that go up into the 80s and 90s. But that's not where we're at. The economy is still growing. It's still very strong. We should not see. It is an overreaction to see 63% of the S&P 500 trading underneath their 50-period moving average. So likely near-term bottom, that's what that is suggesting. Now, another TrendSpider chart that came up on Twitter today, one moment, is what they call a bubble chart. And every now and then I like to look at this to kind of see where the flows are going and see if there's rotation. So this is how it works. That when each of these little green boxes here have the ticker symbol of a exchange traded fund in them, a sector fund. The one up here in the upper right hand corner is XLK, which is the tech fund. And when you see XLK in that upper right hand corner, you know that money is flowing into tech. Yesterday it was way down, right? I think it was even over here in the left side, the bearish side of the quadrant. but now it's bounced back, rotation back into tech, back into QQQ, back into the FANGs, the MAGs, all happening today. We're also seeing some good flows in banks. That's XLF right there. In utilities, well, I've been waiting for utilities to get back on track because it's a fun trade. UTSL is a good one, and FAS for the banks, and TECL for the tech stocks. All good funds to use when flows are back in that direction. What's coming out? Energy. Energy is bad. Real estate is bad. Healthcare still bad. All right. So generally speaking, this bubble chart, you can see changes from day to day. You can see XLK up here in the upper right hand corner and down here in the lower left hand corner yesterday, which I think is where it was yesterday, in fact. I'm sorry, XLK up here today and over here tomorrow. So the rotation trade can be very fast and fierce, but if you watch this bubble chart and glance at it throughout the day and glance at it from day to day, you're going to start to see some patterns, and you're going to see these rotations. You're going to see stocks like XLU and XLF uh, funds, I mean, starting to move in a more bullish direction. And the guys that are getting the outflows, like energy has been getting outflows for weeks now, moving more and more in that bearish direction, right? Moving toward the upper right hand corner is bullish, moving toward the lower left hand corner is bearish. And the last thing I want to point out is this quote from Tom Lee. Tom Lee is the man du jour of prognosticators in the market. It was Mike Wilson, who was at that time, I think, with Morgan Stanley, and he was there for a long time. And he successfully called the 2022 bear market, and he unsuccessfully called the how shall I say this? He remained bearish too long, but he was one of the first to get bearish in early 2022 and made a big name for himself in doing that. Right? He rescued a lot of people who would otherwise have fallen into the bear market trap, and he got them off into bonds and cash and safer havens. But he didn't get bullish soon enough. He missed that May bounce, which is the official end of the bear market. He missed the bottom in October, and he remained bullish all the way through most of 2023. I'm sorry, bearish. He remained bearish most of 2023. And of course, he was no longer a household name. Tom Lee took over. Tom Lee was bullish early. He was bullish back in early 2023, which is a good time to start getting bullish. He's been really bullish on small caps. Now, that hasn't panned out quite as much as I would like them to, but he did call the bottom in small caps. He saw them going a lot higher than they have here in 2024. And he's been bullish on Bitcoin, and he's been consistently bullish and consistently right on Bitcoin now that it's up trading at all-time highs. So Tom Lee yesterday came out, or maybe it was today, came out and said, bottom line, this is a buy the dip moment. The big crash we had yesterday. Maybe more like a back up the truck because the fundamentals did not change. And he's right. He's right about that. GDP still strong. Earnings reports on average, very good. Valuations, okay, they're getting a little bit rich, but yesterday's big slide helped that quite a bit. And leading indicators now going back to positive. Are there some hurting sectors out there? Yeah, there really are. There are some sectors that are trading down near the 52-week lows, and they're probably not going to come back anytime real soon. But the real growth drivers of the economy in tech stocks, and we can break that down. We can look at cloud computing. We can look at software. We can look at anything AI related. You're going to see a lot of good stuff going on. And so there are some good sectors out there. We just have to find the best opportunities and the best risk reward ratios. That's my job, right? That's why I moderate this room to help people find those things. All right, enough about that. Let's jump over and look at some charts. Okay, we'll get to my greens list here in just a moment. Let's look at some indexes first. So let's take a look at, well, first of all, the Dow Jones way, way, way below the LRC. It's still an trending LRC. You will see that start to flatten out a little bit as the prices on the left side drop off and the lower prices on the right side pick up. But really, we're still in an uptrend. We just are. We broke some of the. Let me get my line on here. We did break that trend line right there. And what happens when you break that trend line is that it doesn't necessarily mean we're going to keep going down. We are still in an uptrend, but more likely we're going to start to see a trading range develop, consolidation that would take us into the first quarter of next year. The range lows were probably set yesterday. The range highs were set a couple of weeks ago. And the path of least resistance is going to be, some choppy movement higher into those highs, and then some wavy movement downward into the lows again to test. That's trading range. It's a sideways trend. It's an uptrend under pressure. There are all kinds of ways you can say it, but the easy money on the upside is likely done for a while. I don't think it's a time to get out a whole bunch of shorts or to move to cash. I think you'll be disappointed if you do that. But it is time to be very, very selective, to keep a tighter time frame, um, and give yourself a little more room on the downside with your stops, which means you've got to reduce your position size so you don't take on too much risk. And there are always ways of improving your risk to reward ratio using options. Right? We can sell some calls on top. We can go way out of the money and sell some puts. And then if we get put to shares, we were in at a much lower price. So all kinds of ways of skinning the cat, as it were. But for the Dow Jones, right, we've got an inside day bar. And when the inside day bars happen at the bottom of downtrends, that tends to be a pivot reversal. But we need follow through tomorrow. So if we get an upside day tomorrow, we can say that, yeah, there's a near term bottom in. If we roll right back down and test the lows of yesterday and even pierce those lows, all bets are off. I don't think that's going to happen, but we have to be aware of that possibility. Same thing is pretty much true for the S&P 500. This is a little cleaner chart. We did go down very sharply yesterday, but S&P has not been in that 10-day slide that we saw with the Dow, drawn lower mostly by energy and healthcare. The S&P doesn't have as many stocks in those, and it's much more spread out, right? 500 stocks as opposed to 30. And so here we are, just right at the 50 period moving average. Yeah, we're still a little bit below it, but anywhere near the 50 period moving average is typically a good place to not necessarily back up the truck, but start to do some buying, which we did ourselves in the live room. 50 Pierce right here. We're waiting to see whether we get follow through back to the upside. Here's a 50 Pierce. Took a couple of days, right? And that's probably what we're facing right now. A couple of days to churn sideways down near the lows, and then a big upside bar that was heading into the election. Here's a big Pierce of the 50, right? Well below it. Inside day bar the next day. Would like to see this go green. I don't think that's going to happen. But an inside day green bar led to a nice rally. And here's a deep Pierce, right? Way, way down. And I'm forgetting exactly what that was. Anybody remember what happened back in early August? Was that the Japanese yen carry trade? Might have been. I think that was actually. It was kind of a two-wave down, A, B, C, all the way down. That was a very nice looking place to get long. Are we in a backup? That's a backup the truck moment if there ever was one, but I don't think we're quite there. We are in a cautiously optimistic nibble on some shares, add only if we see some follow through tomorrow, and keep your stops on the wide side and keep your size small. That's where we're at right now. QQQ, the strongest of the major indexes. We just barely got below the 21. We're still well above the 50. That's a big, scary red stick yesterday and on heavy volume. So the problem with these big red sticks, it makes it very hard for the market to climb back up them. You need a little bit of space between that red stick and the new bounce back. And we're not going to get that on day one. The reason why, and we saw it right off the bat this morning, is that when you get a little bit of a run up, people start selling into that. They bought up here, right? They bought at 530, they bought at 533, they bought at 525. They're all underwater. So when the price gets back up to close to where they are, close to being break even, close to maybe even some profit, they're out. They're just out in an instant, right? The pain of holding on to that loss is too great for them to carry, and so they just dump their shares back into the market, and that's why we have this gap and crap that happened today. We're going to see that probably tomorrow as well. We'll probably see that Monday, Tuesday, a little bit of it. But the more we keep running it up to the upside, the more we kind of keep pushing that intraday high a little bit higher, we start taking out that overhead supply. And when everybody's sold that wanted to sell, the market can only go higher. We're not there yet, but it is setting up for that kind of potential. Small caps got just absolutely blasted yesterday, along with the Dow Jones. And an inside day bar again today. It's a gap and crap for all the reasons that I mentioned, but this is the only one that is showing a little bit of bullish divergence in the OBV, which in my opinion is one of the best indicators to see divergence in, because that's a volume indicator. And so this pivot low relative to the last pivot low is showing bullish divergence in terms of volume balance. I don't see it here in the daily chart, but it is apparently showing that. And that is often a very good kind of line in the sand, right? The bullish divergence doesn't necessarily mean that it's going to go up right away, but it is often a line in the sand where you don't get any further downside. You start to see a little bit of upside. All right, let's take a look at our four canaries. So I have these four indicators. Sorry, not indicators, but funds, groups of stocks that I like to look at when the market gets like this. When these are doing well, we tend to see a good, healthy, easy sort of bullish market. When these are not doing well, the market tends to come under pressure. I look at bonds. So TLT is the one I use for bonds. And that very well could be this TLT right here. This is a 20+ year treasury bill. And it's just been in a world of hurt for years now. We've had a bear market for bonds for about 2.5 years. It may be longer than that. And we are at the lowest low since April of this year, right? April of this year. So down in this area, right, in the upper 80s, that's where it finally, after a long slide, finally caught a good bid. We've been lower, right, back here in October. That's the October low. It was a low for bonds as well as stocks. We've been lower. So it's always possible that we could go back down. We could see 10-year yield, which I think is about 4.56% right now. I can see it. When the 10-year yield is up above 5%, it's just ugly, ugly for bonds. Ugly for a lot of things, right? For small caps, for biotechs, for banks, for regionals, for discretionaries, certainly for manufacturing, certainly for commodity plays. We don't want to see the 10-year yield go much higher, and we don't want to see bonds go much lower. So this, I like what it's doing, though, just as a little sign of hope. It is printing a doji. It did flush out to the bottom, well below, actually down near the lows of the really low back in May, and rallied back up. And if we can see a green bar there on good volume, it looks like very good volume, that could be a pivot low. If we get a gap up tomorrow, we abandon that doji down below. That's an abandoned baby. There's a green candle. Come on, guys. Let's buy those bonds. Slap that ask. Slap the ask and spank the bid. I don't know. We got to do one of those. We want to spank the ask, I think. That means you're buying it. And if we can see a gap up and hold that gap tomorrow, we abandon that doji down below, and then that should be it. That should be it for the fall in bonds. So that would be hopeful, but we're not there yet. I also like to look at XBI, which is your biotech sector. This is positive, bullish divergence, right? We're well below the falling LRC, but we've got a couple of signs of bullish divergence. We've got a hammer candle right here. This is not bad, actually, not bad at all. So let's see if biotechs can catch a good bounce tomorrow, just as they did over here back in November. Boy, they've got a long way to go. They've been under a lot of pressure, and they're really not going to do that great as long as interest rates stay high. But it's funny. The Fed has cut now 100 basis points. We've only seen mortgage rates, interest rates, loan rates either be stable or go a little bit higher. So maybe if the Fed is on pause, we can start to see those rates come down. I don't understand the connection there, but it doesn't make sense to me. But it is what it is. So the other things we want to look at are junk bonds. Right? If there's an appetite for junk, for high risk bonds, then there's an appetite for a lot of other good, fun trading stocks. We're not seeing much of an appetite for junk, so we want to see that turn around. And then the last one I like to look at is ARK Invest. This is a speculative, disruptive group of growth names for the most part, some of which don't even have earnings, put together by Kathy Wood of ARK Invest fame. She was on a real roll there when she first launched. She was big on Tesla. She's been big on Bitcoin. She was big on Zoom Media, a lot of the COVID names. And then post COVID, it's really been downhill, unfortunately, for her fund. But she's been out there almost every day buying a bunch of stuff and starting to get now some traction coming back. When you see ARK moving higher, you know it's a good market for the more of the speculative names, more of the growth names, the names that are fun to trade, frankly. So let's keep an eye on that. It's actually outperforming. It is outperforming the Nasdaq, the S&P, the Dow Jones. It was up at not all-time highs, nowhere near that, but up near 52-week highs. Big slam yesterday, more follow through a bit today on heavy volume, but look how close it is to the 52-week highs, not that far below, right? So let's see if that can turn around in the next couple of days. All right. Okay, let's take a look then at my greens index. Oh, I want to show you one more thing before we get to that. If you go to finviz.com, sorry, I need to get rid of these ads. They pop up if you don't have a paid for subscription, but you can access everything on FinViz pretty much for free. You don't get real time quotes, but it's a great screening tool. It's a great one-stop shop. In fact, if you go to the homepage, you're going to get all kinds of cool stuff, including a heat map. You're going to get the economic data for the day, what stocks are reporting earnings, insider buys, and on and on. What I like to do is go to the screener and click on the S&P 500, and I do one simple thing to find the market's strongest leaders right now. This list will change from day to day, so it's interesting if you kind of run this scan every day, you're going to see some patterns. You're going to see some of the same stocks showing up day after day. When you see a new stock showing up, that could be a new leader. So you want to pay attention to that. This is all I do. Very simple. I go to 20-day simple moving average. I click on price above the 20-period moving average. Click on that. And you're going to see right now, out of the 500 stocks, less than 10% are above their 20-period moving average. Oh, come on, ads. Can you just get out of my way here? Let me see if I refresh this. All right. So we've got Apple. These aren't listed in any, I guess they're probably listed by, no, they're not listed by market cap. I guess they're listed by alphabetically per the symbol. We've got Apple, we've got Amazon, we've got Avgo, right? BA is on here. How about that? That hasn't been above its 20-period moving average in a long time. Market leader. CME, I really like this setup a lot. We'll look at that chart in just a minute. It's on my watch list. eBay is on there, kind of an interesting name. I don't really like it, but it's on there. What else? GoDaddy. Yeah. So these are stocks that are strong right now. Now, the other thing that I like to run the scan to look at is the number of stocks that are going up above their 20. If that number is going up, we've got a market that is moving more and more bullish. If that number is falling, then we've got a market that's moving more and more in a bearish direction. It makes the leadership pool easier to spot because there aren't as many of them. And that's kind of, it makes my job a little easier. But I really would like to have 100 stocks, 200 stocks even that are above their 20 period moving average. I don't think you'll ever get 200, but to get a good healthy number, a 3-digit number would be nice because then we're in a good, easy to trade bull market, lots of good strength. Throw a dart at the Wall Street Journal, you come up with a winning stock. We're not in that kind of market right now. We're seeing this number come down. The other thing you can do is to go to the 50-day period moving average and do the same thing. Right? How many stocks are above the 50? 110. All right. So a stronger number of stocks are in an intermediate term uptrend that's above the 50 period moving average. But again, keep track of that number. Is it going up or down on a day-to-day basis? And then the last thing you can do for long term is go to the 200. How many are below the 200? Or I'm sorry, above the 200? Uh, just about half of all the stocks in the S&P, a little bit more than half, are above their 200 period moving average. So that's not a robust number. We're not seeing a whole lot of breadth. We're not seeing a whole lot of participation, and you've got some major sectors that are really hurting right now. Energy is one of them. Healthcare is another, and there's a lot of S&P components there. That's one of the reasons why we don't see this above the 200. But keep track of that number, and you'll start to see the longer term trend. Is it going higher or going lower? All right, that's your trading tip of the day. Let's get back to charts. And I want to go to my greens list. These are stocks. These are not necessarily buy them now kind of stocks, but they are, in most part, they're showing outperformance. They're showing potential for a good quality setup. Just waiting. We're waiting on them. Now, some of them we're already in. So we bought PG, very um, very safe haven kind of play. Very boring, super boring. Really doesn't move very far, very fast. In a market like this, for right now, that's a good place to be. Why is it a long? Well, it tagged the 200 period moving average this morning, rallied right back up. We're up near the highs of the day. We've got a nice green hammer candle right there. And after a long pullback, that should mark the bottom. We've got our stop just below the low of today. Our target is up here in the upper 170s. It's not a big trade. It's what, 4 or 5%. But in the market like this, we can take it. Now, because of the fairly tight stop and because it's not a lot of upside, we've got a full position on this when mostly we're trying to get into smaller positions. We went long snow as well. It is not really doing what I would want it to do today, but it is showing some really good outperformance. Yesterday was a big slide for tech stocks. Snow didn't go down much at all, not really much at all compared to that. Here is your power gap, right? A big gap up. That was on earnings. Always good to see it on earnings to 52-week highs. We haven't gotten into that gap. You're going to see a lot of power gap setups that I've been collecting where the stock price is now inside that gap, even closing the gap altogether. That's not a good sign, right? That's saying the market made a mistake. But when the power gap is like this, and even with stocks under pressure, especially tech stocks under pressure, and it's holding that gap, they're right on sitting on top of that gap. It's saying the market is absolutely right, absolutely nailed it on earnings, saying it's no longer a $130 stock. It is now a $160 something stock, and we're not going any lower. So what I like about snow is that it is a good risk to reward ratio, which is hard to find. You can keep your stop fairly tight, right? You got to keep it underneath the lows of today, the lows of yesterday, inside that gap where we don't think it's going to go. And then your target is up here at the recent pivot highs. We also bought some MA, which is a credit card. Retail sales are still strong, very very strong. In fact, consumer sentiment's still good, and it's Christmas too, so people are out there shopping. Credit card companies making good money, and also making especially good money with rates as high as they are. So here's your outperformance. We're above the 50 period moving average. Yeah, it was a slam yesterday with everything else, but a nice looking inside day bar, bullish one at the bottom of the LRC in the pink zone. Not an exciting trade, but again, perfect trade for this kind of market. Here is CME. I really like this setup. I just have a feeling like it's a little too perfect. So the stock does like to do these rounded bottoms, and then it follows through for a little bit, and then it kind of morphs into another rounded bottom, follows through for a little bit, another rounded bottom. Here's a nice rally right here, all the way up above the LRC. Hit some bearish divergence up there, a little bit anyway, right back down to the 21 period moving average, which held like a champ. Absolutely held. Yesterday, when the market was falling, CME was going up and follow through day to day. Very good volume yesterday, light volume today, but that's okay. Now, here's the thing about CME, it is an exchange trade, exchange company. So when trading levels go high, CME makes more money. And that's one of the reasons why it was up yesterday and everything was down, because everybody's trading, right? They're trying to get out of their positions. Help, get me out, get me out. And so a lot more trading going on yesterday. Good for CME. Its price went up. And I'm starting to think that, maybe if the market does kind of cool off and gets a little firmer and stabilizes and the volatility comes down and all of that, CMA may not be able to get back up to those highs. So we'll keep an eye on it. But just as a pure technical setup, that's a real beauty. Um, some of us are in NVIDIA. Not a good day yesterday, but it was better than most, right? It started off high, and then it was a gap and crap, and then it bounced back up again today. So it's still up, but it really has trouble at 133, 134. If it can get up through 134, 136, up here is the next test, and then 140 for the 50 period moving average. It's got a lot of testing to get through. Not going to get it's not going to give us a big green stick anytime real soon. At least that's what the chart is telling us. More likely, it's going to have to kind of churn its way higher. Right, one day it goes up, a couple of days it's tight, but not bullish, and then back up again to a little bit higher, and churn to the side, and then back up again a little higher still. That's just the way it's going to have to be with NVIDIA. And yeah, it will get back on track, but this pullback is the real deal. And still not impossible that this is, in fact, a head and shoulders top, which would be nasty because that would bring it down to, I don't know what it was, 120, I think, 115. Um, if it completes that pattern. And you can see the left shoulder here. Here's your head. Here's your right shoulder. And your neckline. I wouldn't put the neckline right there. I think the neckline's a little bit higher right there. So that's still possible. I say this all the time. Head and shoulders tops, very unreliable. They tend to be actually falling wedges in disguise. In other words, more of a bullish pattern than bearish. We are in the pink zone. It is LRC uptrending. That's in my mantra: buy the pink in an uptrend, sell the blue in a downtrend. This is a buy the pink moment. And it is NVIDIA. Everybody has to own NVIDIA. So we'll see where that goes. DOCS is one from my trend trade letter. It was, we had like 3 stop outs yesterday in the trend trade letter after a really nice run. We had like a 10 or 12 nice profits in a row, and then we hit this patch of stop outs. Very same thing happened in the live room as well. We hadn't taken a loss since mid-July, and then we went through this long weeks of profit, 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 profit every week. And then we got a little stuck last week and even more stuck yesterday. Yesterday was bad. Had a really good couple of days initially. I hit my all-time profit highs in my own trading account on Tuesday. And then Wednesday came and everything, we had to give back quite a bit of that. Now, DOCS. Look how this is so easy to spot in a very weak market day with everything big red stick, right, to the downside. Hardly went down at all yesterday and closed very close to the 21 period moving average. The old adage is that above the 21, good things happen, below the 21, not so good things happen. And when the market is looking for fresh blood, the market is looking for alpha, this is the kind of thing you look for, right? In a weekday, outperformance. You saw that in CME. You see that now in DOCS. It's a beautiful setup. I'm not sure how much more upside is here, but low 60s is probably where that's heading. We'll take a quick look at Labu. It's a painful trade because I was in a yesterday. I was in a put right and was out all afternoon when most of the selling was taking place, and then had to anyway, it's my fault for not closing that out before I went out. It is giving us the potential for at least a little bit of a bounce to the mid 90s. It's got a volume shelf right here at mid 90s. It's got support below in the low 80s. Don't want to see it go down there, of course. But a hammer candle today with bullish divergence gives it a little bit of hope that this will get back up above that shelf. And then it's going to have to crawl and climb its way, probably slowly and choppily, up to the 50 period moving average. Not that interested in putting that one on, but let me show you a few that might set up for us. Flute, fairly soft pullback, not doing too well today, but it is showing a little bit of a reversal in the pink zone of an uptrend. PODD, this one stopped out, and one of the ones that stopped out in the trend trade letter yesterday, but it is a doji today, bottom of the LRC. We're above the 50, outperformance, and it's a very strong chart. Here's your power gap, just barely inside the gap, but really close to the top of it. I like this setup a lot. We just need to see some evidence that people are buying it. TPR was also on my watch list this morning. Good outperformance, right? Here's your power gap. It just was up, up, up all after a short and quick test. It's been upside. Here's your rounded bottom. Downside yesterday, of course, a gap and crap today so far. So it's not giving us the right setup, but it's close. I like Walmart as well as a good safe haven play. Nice little bull flag forming. Very nice. In fact, I might even get us into this one today before the end of the trading. I like that a lot. CRM is not there yet, but it's outperforming. We're still well above the 50. There's a little bit of gap and crap, but we need to see some good bullish movement there. We're not seeing it. Cisco is pretty good, right? A little bit a reversal on the rising 50. And GMed is also outperforming. Here's your power gap. We're not inside the gap. We're holding at the 21. And I think that was about it. We'll take a look at Le Mans because I know there was somebody in the room interested. So really strong uptrend, along with a lot of software names like Upstart and Unity and others, PLTR. And then it hit the blue zone, typically a place where it cools off for a little bit, pulling back, pulling back, pulling back, pulling back, pulling back, still pulling back. So it's not a buy yet. I would say let's wait until it gets up above at least the midline of the LRC or the 21 period moving average. I would even consider it to be a buy if it takes out tomorrow, if it takes out the intraday high today. It's not a buy right now. I would stay out until those things happen. The other one I want to show you is TTD. Outperformance, good uptrend. We're still above the 50. It's not doing very well today, so it's not a setup yet. But we've got the potential of a nice reversal that you see right here, right at that 50 period moving average. Wait till that happens. Don't buy it yet. All right, guys, I'm going to let you go. I don't really have time today. We only have about 45 minutes left. I want to make sure that we're well positioned for tomorrow's PCE prices. Could move the tape a little bit and options expiration. And God bless everybody. Have a great rest of the afternoon. We'll see you back in the room in just a little bit. Bye for now.